Good Monday. This is Jay Brew, co-chairman of Seafried and Brew. I wanted to point out that the webcast that we did on April 29th was a webcast that should be shown in every boardroom, should be shown in every ALCO meeting, should be shown to the senior management team. Because in that broadcast, Dr. Ed did a superlative job in terms of really balancing where the Fed is going. And I think that when you look at this and you look at the overall situation, that essentially a static environment from the Fed, no changes. Even with the increase in non-farm payrolls, you still had an unemployment rate that looks stubbornly high. Along with that is the jobless claims, moving up well over that 400,000 mark for 2 weeks in a row. And as we keep on saying that European malaise on the Fed's mind in here of the people that have had the extended unemployment benefits is weighing on the Fed in terms of employment moving forward. So as we look at this and we then take into account the housing situation with some very bad news over the past couple of weeks in terms of prices on homes across America still continuing to decline in here, add into that ever-increasing problem when you drive up to the gas pumps and look at what people are paying to fill their vehicles, is that most likely these things continue to weigh, even though the volatility in the markets is really pretty incredible. When we look at oil having dropped like 15% last week, jumping back up in here today, that volatility in here is going to cause overall concern, not only with prices, but in terms of, I think you're going to hear people talking about recession again. Once again, Dr. Ed and I do not feel that recession talk is warranted, but I think that as we experienced last year is that there's this continuing feeling that we could see a double dip situation. So the result of this is the yield curve. And a big piece of news, of course, is that where we topped out at around a 380 on the 10-year Treasury is amazingly enough today it's at 314. This is in the face still of the fact of the Fed ending QE2 and their buying of Treasury bonds. Along with it is that a lot of people haven't talked about T-bill rates. And you want to look very carefully at where T-bill rates are in here, because we look at the 3-month T-bill at a 0.01 yield. It only moves up 5 basis points in 6 months to a 0.06, and 1 year is a 0.16. Where when rates were higher recently, we were talking about the quandary that a lot of community banks may not be able to cut their deposit costs in here as their yield on earning assets continue to run off and move downward. When we look at this is that we might want to think about the risk premium. And the risk premium right now on T-bills is reflected of the Fed's static situation into the future at really a zero cost basis. When we look at that is that then look at our deposit rates. Once again, with the FDIC insurance, with the trust premium, can we lower our deposit rates even further in here because of where the rest of the markets are? In a world that is very volatile, at a time when we still have a European Union problem, Greece being downgraded to a B rating, still not being able to get their act together over there, once again, puts this whole pressure of malaise on the markets. And it's not only employment, it's housing, energy prices pushing down, and what's happening in the world right now. So to reevaluate where we think we can move those deposit rates to based upon the risk premium, I think every bank should look at their short-term cost of funds and determine whether decline is warranted. This is Jay Brew, co-chairman of Seafried and Brew. Have a good week.